Hi guys, I'm back and this time technical topic TDS on purchase of property from an NRI. Why this topic? Yes, because it is different. What's different? Suppose I'm buying a property from a resident. I deduct 1% TDS and deposit into the government account on the 30th of the succeeding month using form 26 QB. Yeah, so follow the same thing, no? For an NRI seller, no. There is a difference. So what is the difference? The difference is one, the tax deducted is not 1% of sales consideration but higher. Two, the date of deposit is not 30th of the succeeding month but it is the 7th of the succeeding month. And three, you don't use form 26 QB but do a regular tax payment using a TDS challan and thereafter file a quarterly return. Now, why all this different? Because Form 26 QB is specifically to cover only that specific case wherein a property sold by a resident seller. There is no other provision. So, in case of a non-resident seller, you follow every other type of TDS provision, right? So, how do you go about it? Tax is to be deposited. There is no tax rate prescribed, but what is prescribed is taxes which are required to be discharged by an NRI seller. Now, as a buyer, how do I know what an NRI seller has to discharge? You all know how to calculate capital gain tax, right? It is the sales value less indexed cost of acquisition, cost of improvement, net profits, which are my capital gains, and then for a long-term property, if I'm talking of a property, a residential property or a commercial property which falls into the long-term category, the taxes are 20% plus applicable surcharge and cess. Right? Very simple, no? But do you think it is as simple for a buyer? How will I as a buyer calculate the taxes that are required to be paid by the seller? The maximum what I will know is the sales value because that is agreed with me. I don't know his purchase cost, his purchase date, cost of improvements, any commissions, any other cost of selling or purchasing which he has incurred. Nothing is known to me. So the seller will say, okay, I will provide you those details, do the calculations, deduct taxes and get free. But do you really think it is so simple? No. What happens is, the buyer sits down to make all those calculations. We all know the departments might allow certain expenses, they might not allow certain others. Right? So as a buyer, why and how do I take responsibility of calculating the net capital gains? Applying percentage thereupon is fine, but how do I calculate the net gains? How do I take the responsibility thereof? Right? So buyer is always afraid of doing it, and what hence they do is the 20% of net profits is replicated by 20% of the sales consideration. Do you really think both are same? No, right? Yes, both are different, but do you really understand the extravagant gap between the two? I'll just calculate it. Say I'm selling 1 crore worth of property, right? The sales value is 1 crore. The NRI seller had purchased it 15 years ago at a price of say 40 lakh rupees. I index it as on today to come to around 75 lakh rupees. Okay, simple till here. Now the profits of 20%, the tax of 20% is to be applied only to 75 minus 1 crore, that is 25 lakhs. And if I apply 20%, it is 5 lakhs of taxes. If I apply the surcharge, if I apply the cess, the surcharge is anywhere in the range of 15 to 25%, right? Surcharge is 4%. So the rates vary between 23.9 to right up to 26%. And hence the taxes of 5 to 7 lakhs when get converted to this 23 to 26% gap on sales value, my TDS deduction value gets as high as 23 lakh 92,000 to 26 lakhs, nearly 4 times. And what it actually, the NRI is not required to actually discharge so much tax, but it is like a burden to him because that amount will be withheld by the buyer, deposited in his name to the government, and after the year end when he files his return he can claim it back. But the gestation period can be anywhere between 8 to 10 months to 4 years. Big burden, right? So what can the NRI do in such a case? Rather than giving all this explanation, the figures, the calculations to the buyer, he can go to his assessing officer, give him everything required, and obtain a lower TDS certificate under section 197. The assessing officer will do real-time calculations, pen down whatever is acceptable to him and whatever is not, and give you a simple rate. If I talk about the illustration that we were talking about, suppose my basic plus surcharge plus cess comes to somewhere around 5,50,000. The assessing officer will calculate 5,50,000 divided by 1 crore to give me a rate of 5.5%. I take this certificate, give it to the buyer, and now the buyer is simply required to follow this rate, deduct taxes of 5,50,000, deposit in the government account. Is the buyer done? No. What is different? I told you. One is the date of deposit, and most importantly here, the buyer also needs to take a TAN. It is like I told you, not through 26 QB. So what next? So what they have to do, like a normal TDS return, this buyer has to do the same process. Deduct tax, pay under section 195 through a normal TDS challan into the government account before the 7th of the next month, and at the end of that respective quarter, file a normal TDS return under 27Q, and thereafter he is done with it. So when I told you what are the major differences, the rate is not 1%, but it is anywhere between 23 to 26%. The date of deposit is not 30th of the succeeding month, but it is 7th of the succeeding month. And the return cum challan under this is not Form 26 QB, but a real-time TDS deposit challan and a TDS return under 27Q after the quarter ends, having taken a TAN, right? So be very careful about it. Don't do it as a simple 26 QB 1% deduction and wash your hands away, because the entire responsibility of a mistake will not be with the seller but with the buyer. The government will come to me, they'll hold me responsible in case there is any short deduction. In this case it is, right? So they'll hold me, they'll ask money from me, they'll ask penalty and interest from me, and the seller I can't go and take it back from, right? So be careful, be smart, and if you don't understand, approach a chartered accountant. Bye-bye.